Please welcome back to the stage your host, Garrett Van Manen.
All right, folks, all right. Best ever. How was this morning? Did we learn something? I think we did. I was backstage, so all the graphs kind of read a little bit different behind the screen, but I still think I was getting the gist there. It sounds like multifamily's making a comeback. We're learning how to kind of map the future a little bit, but we're going to shift gears from going and looking at graphs, looking at charts, kind of predicting where the puck is going, and talking a little bit now about capital allocation, particularly for the GPs in the room. How do we go about raising bigger pools of capital, getting more debt, getting more equity as we scale our businesses up, and maybe we look to shift from syndicating to more institutional styles of capital raising? How do we make sense of the environment? How do we present well as sponsors? And that's what we're going to be covering in this next panel. For those folks who are in the hallway, feel free to make your way on back in because we've got an exciting 45 minutes coming up ahead of us. And next, I would like to welcome up these three panelists who will be on the stage with me here. Gents, come on up. Quick round of applause here, please, guys. Awesome. Bobby, thank you. Tyler, thanks for coming all the way. Garrett, great to see you. We have two Garretts up here on stage with us today. And
one real one fake one.
That's right. And we're sitting next to each other to make it that much more confusing. But gentlemen, thank you so much for being here with us. And we're excited because one of the things that I'm most excited about with this particular group of people is we've got folks from across the capital stack with us today. First up, Mr. Garrett Nondorf from Flagship Companies. Flagship is based out of Houston, and they invest on both debt and equity in what's called, what I say is maybe sub-institutional and JV debt and equity, which is a really important kind of spot to fill in the market. Tyler Figley is joining us from New York City, from Wall Street. He's with Aphinas Capital, and Tyler particularly focuses on institutional lending, institutional equity, and debt packages. And if I'm not mistaken, you're really kind of running the book for the self-storage asset class, right, Tyler?
That's right. Yep.
Awesome. And also Bobby Sharma, co-founder of Connected Capital. Connected Capital is a pooled investment vehicle, and they are using fund-of-funds, allocators to make sophisticated investment decisions and write larger check sizes. So quick show of hands, who is maybe thinking, hey, I've syndicated some deals. Now it's time for me to start playing in some bigger leagues. All right, I see a few hands up there. And that's what we're really covering for the next 45 minutes, and we're going to spend a little bit of time talking about. But folks, one of the things I want to jump into is if I'm a sponsor and I'm trying to present well to an institution, to a sophisticated capital partner like yourselves, what is one of the most important things that I should make sure that I get right? Beyond track record, beyond the typical things that you see, how do I make sure that, when my deck hits your guys' desks, that it's appealing, it's attractive? Garrett, what are some of the things that you see immediately?
Number one thing is, and thank you for all those great intros, Garrett. Number one thing is being able to talk your deal. If you get on with me, as the originator, and you can't tell me what the exterior of the building is made out of, or what, why NOI is trending one way or the other, that doesn't make me feel confident that I can put you in front of an investment committee. I can't take you home to meet my parents, essentially, if you're not going to be a grown-up about it. So being able to know all those little details about the deal gives me the confidence to take you further into the process. I mean, we had a deal in south of Nashville last year. These guys were growing their business. They were moving up into unit count, and we get on investment committee meeting, and my head guy built 10,000 units back in a previous life. And he's like, well, what's the building made out of? And they couldn't answer. They're like, we're going to get you that answer. I was like, well, it's too late. Yeah. So know your deal.
I think you touched on something important there, which is the folks who are on these investment committee, the parents, if you will. We've got gentlemen, Bobby and Tyler and Garrett, and they're out there, they're looking for opportunities. They want to meet people like you because they need deals to bring back home. But if they're going to take them to the parents, those parents, they're pretty sophisticated operators, and they might have challenging questions like that. Like, Tyler, what do you run into when you take something to investment committee that you need to make sure that sponsors have down pat?
Yeah, so for context, we have an equity platform and a debt platform. Last year we borrowed about $8.5 billion on the equity side, and then on the debt side we placed $5.5 billion. So if you guys are bringing me deals and it's not buttoned up, I'm just going to move on to the next deal. I don't have time to babysit and go through the DD with you. I'm expecting all of that stuff to be buttoned up. have your pitch, have it down, and then like bring it to me when you're ready. So like for us, it's more of like an opportunity cost. I only have so many hours in the day. It's like, what am I going to spend my time on? So that's like, for context, that's how we're kind of set up.
Yeah. So for us at Connected Capital, very similar. Maybe the numbers are a little different compared to Tyler's, but we again, know your financials, know your asset, know your market. We will look at people that have done deals similar to what they're presenting. We want to make sure that we are not the guinea pig for them on this asset. So we want to see a track record. But most importantly, knowing their market, making sure that they've run the right comps, that they have a proper, realistic exit strategy, their loans and their equity, their capital stack has to be in order. Obviously, we want to see them have some skin in the game as well, but more importantly, that they've been through multiple cycles before. We've seen an upswing, past a decade, and then we saw a downswing. So we want to make sure that they've survived the downswing and come out okay. So those are the things that are important to us.
And for context, with just the groups that we have up here on stage today, what is a typical check size for all three of you? Bobby, what kinds of checks are you guys deploying?
Yeah, so we're just under $2 million per check. So last year, so we've only been in existence for a year as Connected Capital. So we launched in late 23, and then finally got going in 24. We looked at 66 deals. We funded 6. And average was about just a little bit under $2 million.
For us on the equity side, it's a minimum check size of $35 million, and then the average is probably north of 50. And then on the debt side, for construction lending, our average loan size is about 120 million. On the bridge side, it's about 55 million, and on like the fixed rate side, it's about a little over 30 million.
So the numbers are a little bit bigger there, but the concepts apply. I keep sending my deals to Tyler, and he keeps saying, this is too small, Garrett. And then, JC, how about you guys for Garrett for some of the JV equity that you guys are doing?
3 to 7 million is our preferred check size, and on JV LP equity. And then we've got a bridge debt fund that does $5 to $15 million loans. Probably a little bit below what Tyler's looking at.
So the checks are different, but ultimately the way that they are vetting people is really the same. And when you guys are looking at sponsor differentiation, is there anything that a sponsor can do or that can show that shows that they have a competitive advantage in their thesis or in their approach? How are you guys looking at that, Garrett?
The easiest one is that they live there. They live where the deal is, or they're going to move there. That gets investment committee excited because we know from being, owners a long while ago, when you're there, you're just driving past it, you're checking in on it, you're thinking about it more often. That's what we want in all of our deals. We did 5 deals last year. We're very selective, passed up on probably 1,000 deals. That means a lot, and it's an easier one to do. There's probably a bunch more these guys can think of.
No, I mean, I think that's like a really good differentiator when we're talking about, if I have 10 different deals on my desk, like who knows this market, who's able to structure these deals and get ahead of like the rest of the market and like really create that value add. I think that, that can really allow you to differentiate yourself when you're compared to, these other deals that we're looking at.
Yeah, we are in closing for a deal in Des Moines, Iowa. One guy lives in Minnesota, the other guy lives in Cali, but they own 3 or 4 other deals just in Des Moines. And so that was another way to get over that.
Yeah, same. We want to make sure at least one of the key partners, one of the GPs, is in that location, or like you said, they have assets, they have proper boots on the ground in those markets, and they really know the local market inside out. Sometimes we have sponsors that come in and they bring a comp, and sometimes they only present the best comp, and then when we go and do our research, we realize that there's other comps that are not as favorable, so they haven't done their homework. So that's a big red flag for us. But yeah, having very deep familiarity with the market, and maybe sometimes if the deal is right in their backyard, it's always a plus. Maybe they know something about the changing zoning environment. Maybe the city's about to deploy, more capital, or there's things that are in motion to make that neighborhood better. And if they're getting in early, that's important to us. Or if the GP has some secret or some knowledge about the loans, or a broker is bringing a deal to them before they're bringing it to the market. Maybe they have those certain broker relationships that they're getting a deep discount on that asset. That's important to know.
Sure.
Yeah.
You mentioned comps, Bobby, which is, I think, an important, data plays an important role when we're pitching an investment. And if you had to design a winning sponsor that was going to make it through investment committee, like Tyler, what would that look like? What data would you bring? And if the data is not great, how do we go about creating a narrative around that data that can help you get something through investment committee?
Yeah, I think more and more today, there's more and more data providers. We all have access to it, so we're all looking generally at the same data set when we're evaluating these decisions. And I think, from a sponsor standpoint, we're really looking for you guys to help navigate that data and present it and slice it and dice it in a way that makes sense and helps validate your business plan. So for us, it's really because we do the equity and the debt on a lot of these deals and in all of these markets, it's really, okay, how does this basis compare on an equity deal versus a debt deal, and how does that relative value stack up? So it's just really kind of understanding the market and the granularity of the data that's being presented and being able to make an informed decision based on that.
One of the things that I kind of am getting as a trend is that you need to make these guys get comfortable with your deal. Garrett, how do we get comfortable? How do I get to meet you? How do I find people like you? And then how do I end up building the relationship such that I can get you comfortable? I can walk you through the data on this particular deal and say, hey, maybe there were 1 or 2 bad comps in there and there's 7 or 8 good comps, and say, hey, but here's why I want you to focus on these 7 or 8, not these 2.
Yeah. Well, we can talk after if you really want to get into it. But you can send me an email. I reply to pretty much everybody that emails me, and it's on the website. We're looking at deals that are $10 to $40 million total cap, and so we're looking for emerging sponsors generally. We did a deal in Springfield, Missouri last year, actually 2 years ago now. It was their 2 guys, their first time as GPs. They were coming out of bigger shops. They had done acquisitions for a long time, but you were taking a chance on those guys being, operators for the first time. And the way we got comfortable, I got comfortable with them because I liked them a lot. They had a really clean record. They spoke eloquently and knew their deal. And then it was a good deal, frankly. It was a mid-80s in Springfield, and I think it was like $100 a door or something like that. Good cap. It was like a 6.5 cap. Well, we go take investment committee there, and as we're driving the market, Mike is the GP. He can speak to every comp we go to. That is not, frankly, that's not the norm with all my GPs, but Mike took over, and when we got there, he was correcting the PMs on, oh, no, it shows this on the website. He just knew it cold. That helped a ton.
That makes a lot of sense. It sounds like we have to kind of, one, I love that you touched on emerging sponsors, because I think we probably have a lot of emerging sponsors in the room. Hands up if you think you probably fit in that emerging sponsor bucket, maybe less than 5 deals completed full cycle or something along those lines. But they had a sophisticated background prior to that.
Right.
Bobby, you probably see a lot from emerging sponsors. How should emerging sponsors go about saying, hey, I don't have this sophisticated track record, but here's what I'm doing to mitigate the risk?
So again, very easy to reach out to us. I do a lot of the pre-vetting, making sure that this is an investment that's going to resonate with our fund managers. But as far as if they're slightly less experienced and they don't have the proprietary data about that market or about that asset, they can. One thing we do, we're very transparent. So if you're thinking about raising capital from Connected Capital, every Friday at 9 a.m. Pacific, noon Eastern, we do it's an open presentation. I encourage them to come and attend and observe other presentations. It's all on Zoom, and there's no cost to come in and listen. Just be an observer. See what's working. See what the other presenters are presenting. What kind of data is important to it? What kind of questions are the fund managers asking? And so very often I tell them, and they're always in a rush to raise capital, right? But I say, listen, tap the brakes a little bit. Come and attend a couple of presentations, and then you'll be better prepared when you come in and you do the final pitch. But we do pre-vetting, and I would say 50% of the time they're not ready. And we just let them know that, listen, come back to us when you have another deal.
When you say they're not ready, what does that mean?
They don't have their numbers right, or the numbers are too optimistic. Because they're emotionally tied to that deal, because they've got time and maybe they got some hard money down on the down payment. So they're emotionally tied to that deal. But because we see, and I'm sure all the people on the panel, we see a lot of deals. So we know that, listen, for this area, you're describing it as a B neighborhood. It's not. We've seen other assets in this.
I can't come to pitch you and then just lie about market condition. Okay, I'm going to jot that one down.
So yeah, we do our own due diligence and underwriting. But yeah, so mainly it's about, like you said, knowing your numbers, knowing that you're getting into a C+ asset, but don't sell it as a B asset to us or to your investors. Just be conservative and just do all the stress testing that you need to do to make sure that you're going to be coming out alive on the other side. But yeah,
when the best thing that can happen is when they say to investment committee, it's a D+ neighborhood, and investment committee after the fact says, I kind of think of it as a C.
That wasn't so bad.
That deal's
it
going to get
happens.
done.
Yeah. So that's actually an interesting thing, because I think that we see this all the time where, no, this is a A asset. And I'm like, isn't it from 1970 or something? And how important is it to just paint the picture more factually as opposed to putting the rose-colored glasses on?
So what I'll say is, what I really appreciate when I'm looking at deals from like an emerging sponsor, right, is like, have your strategy in place and be able to explain like what you want to go out and accomplish in the market, and then go find your deal that fits that thesis and that business plan. Don't like try to get a deal and jam it into a business plan or a thesis. Like that's where I think you get in trouble. That's where you start making assumptions to make a deal pencil as opposed to the other way around. So I see that quite a bit, especially in self-storage. Like you get all sorts of stuff, but if you can actually have that thesis, you have conviction in it, then go find the deals, I think that's the better way to do it.
Yeah.
It's hard advice in today's world because the transaction volume is so low. When you do see a good deal and you want to fit it into your profile so hard, even we, as the allocator, this deal in Des Moines is 50 units. It's below it's a $2.5 million check from us, which is below our minimum where we like to be. But gosh, it was a good deal on the fundamentals, and so we fit it in there.
Yeah. How important is it to say, okay, I do value-add multifamily. That's my business plan. Here's an opportunity. Maybe it's not value-add. It's just kind of like a core plus type of asset, a little bit of a coupon clipper. That's not what I usually do. Is it okay for me to make a pivot in terms of business plan as long as I have experience in that asset class or in that market?
In that example, I'd be more comfortable with that because if you've done value-add, you ought to be able to do the coupon clipper. Do you guys think the same?
Yeah, I agree.
I agree. The only thing is they should have a partner in the deal that has done maybe ground up or whatever the new shift is. They should be somebody that really has a deep understanding on the team. But yeah, you can have a partner who's only done value add maybe in a certain geographical area, but now they want to branch out into another area, and But yeah, we will consider that as long as. The one thing I wanted to point out, the one biggest mistake that I see right now, sponsors making is saying that they'll do a rehab on some of the units, and they'll be able to raise rents considerably, right? Yeah, they'll get a $200 bump on the rent because we're seeing that that's not always possible, or if it's not always possible in the timelines that they're projecting. Maybe it'll take twice or 3 times as long. But yeah, you might get a rent bump. But so we're seeing some of those things come up very frequently in our presentations. Very optimistic occupancy rates and very optimistic rent bump rates. So if they're saying they'll get a $200 rent bump, they may only get a $75 rent bump. So they got to be prepared for that as well. Yeah.
So I'm sensing a trend, which is don't be duplicitous. Market your deal accurately. Assess your market correctly. Have a business plan in place. What other kind of like quick bullet points should we add to that list as sponsors look at, I need to raise some equity or some debt for my next project?
Things not to do or things to do, or both?
Either way.
It's funny, you think there's a ton of them you've seen, but
Yeah.
I can't think of one right now.
Yeah. Well,
One
for
question
us,
sorry,
yeah,
go ahead.
Sorry. For us, what we want to see, if there's a team, we want to see that the team's been together for a while, right? They have good chemistry together, that they're complementing each other as far as skill sets are concerned. We want to see a solid team, and they bring deep, knowledge, or that they have experience and they've survived some challenges. And if they've had a capital call, share that with us. It's happening every day. It's normal now. But let us know that happened. Or if they're doing a pref equity raise, no problem. It's what's going on. It's realistic. But share that with us. Don't try to sugarcoat it. Yeah.
I want to talk about timelines real fast, because Bobby, you mentioned something about how a lot of times sponsors come to you, they're in a rush. What's it typical, particularly in the institutional world, how long does it take from when a deal first hits your desk until it can actually legitimately fund?
Yeah.
Tyler, what are you seeing in terms of realistic timelines?
So for us, there's a lot of different layers that we have to go through with our investment committee. These just being larger, more institutional deals. So typically for us, but from the time we get it, by the time we underwrite it, get it through our process, it's probably like anywhere from 60 to 120 days before we're actually closing. Mm-hmm. And so we have a pretty involved due diligence process. So it just takes a little bit longer.
What point are they are they assigned LOI or assigned PSA when you guys?
It usually takes us from the moment we get the deal, probably 3 to 4 weeks to get them like a fully vetted term sheet. And so for us, just to kind of give you guys like a sense of the process, right? We'll, as a deal team, we'll underwrite it, we support it, we'll elevate it. And in order for me to get like a term sheet out to you guys, I have to go to our investment committee, which includes like our CEO, CIO, head of credit, and some other folks. So it's a very involved process. And so, going back to what we were just talking about, like if I don't have all my ducks in a row, I'm not going and speaking and wasting those guys' time, right? So it's doing a lot of the work up front, getting very comfortable with it, and then it's just really getting it through our process, doing our due diligence.
And part of that is the sponsor being super cooperative with you guys, because ultimately you only have whatever information they're willing to give you. But if they can't get everything that they need from you, there's no chance Tyler's going to want to take that to credit committee. Yeah. Garrett, what are the types of documents that people should have prepared that they should say, automatically I'm going to ask for this, this, and this, and I might come back 10 more times and ask for some other stuff too?
Number one, the Excel model. If you send me the Excel model and the property address, I can get you a lot of feedback just based on that, and maybe the year of construction. But, the process on our end, we've got 2 investment committee members who've been together for 20 years, so their buy box is pretty well defined at this point.
Yeah.
Say you send the deal to me. You got the Excel model. Maybe there's an OM, maybe not. And I'll send it to my analyst, say, hey, how's this look? He gets it back to me that day or next.
I should send you my rent roll in a PDF form.
Please do. Please do. That will definitely kill it straight to the trash. He sends it to me the next day. We'll look over. It's literally a blurb. So spending your time on these big, beautiful OMs, I think is valuable later in the process, and certainly at Tyler's level when you're taking it to the CEO, CIO, et cetera. But for us, just to get our attention, the numbers need to work, or we need to know you pretty well. And so we'll send it off to underwriting. That's in India. It comes back the next day. Analyst fixes all the errors they had and gets it ready to go. Then, is it under contract or is it under LOI? If it's under LOI, we get you high-level feedback. Yeah, we like the deal. Here's the questions. Here's the concerns. We've talked about it to committee. Our committee meets 2 times a week, Tuesdays and Fridays. And then from there, hey, we've got it under PSA, Garrett. Will you take it to investment committee in a more fulsome manner? Yes. That's a 1-page document. It's literally an executive summary. We get that to them the day that you tell me you're under contract. They'll give me questions, or sometimes they'll literally give me an emoji thumbs up if they want to have a call. I've gotten that a few times, which is great. That's what you want. We set up a call a few days later, and if that call goes well, we get you soft terms in an email the next day. Mm-hmm. And then from there, we're working towards a term sheet and stuff. So we can close 20 days from a signed term sheet, but getting to that point it's probably a couple weeks of vetting the deal and then negotiating.
I like that you touched on, like, send me the Excel file, send me the underwriting model, because your sophisticated investors, your average $50,000 investor isn't going to go re-underwrite the entire deal themselves, but you guys will at Aphinas, at Flagship, at Connected Capital. You guys are going to take this through the underwriting model yourselves and test pretty much all of those assumptions and see how that proves out. And what kind of red flags are you looking for when you get someone's underwriting file?
Cap rate, exit cap rate that's 100 bips lower than where you're going in is a good one. Yeah. That'll help me pass the deal really quickly. Rent growth you talked about, that just doesn't pair with the comps.
Yeah. Yes. So numbers, so we are very data driven. And as far as timelines, you do a presentation on a Friday. By Friday afternoon, we have gauged the interest level in the deal by Friday afternoon. And if there's enough interest in the deal, so at least 4 or 5 fund managers that raise their hand and say, yes, we like the deal, we like the team, we like the market, we're willing to raise capital. Then we request your deal room. If you have a deal room that you've already prepared for other investors, just send us that link. If there's NDAs that need to be signed, send that over to us. We'll sign the NDAs. But we only let the people that have raised their hand get into the channel on the Slack channel, and they have to get in by signing an NDA. We don't want your information. We want to protect you as well, and we don't want your information floating around. So, but by either Friday afternoon or Monday, we have a dedicated underwriting team. We will re-underwrite the deal ourselves. We'll take a look at your underwriting model, but usually we do our own underwriting. And then we do due diligence. And then by Tuesday or so, we've got it a ballpark. Let's say the deal checks out. After the underwriting, everything checks out. So the things that we look for are underwriting the deal itself, the market. It could be an amazing asset, an amazing team, but in a market that's not desirable, right? So that'll disqualify the deal. It could be an amazing asset in an amazing market, but the team doesn't quite qualify, so that'll kill the deal. But so we look at all those things, and then by Tuesday or Wednesday, we can come back to the sponsor and say, listen, we believe we can raise between X and Y. We'll give them a range because we need to get firm commitments from our fund managers as well. But after that, it's about a 4 weeks to raise the capital. We've done it sooner, but only for repeat sponsors that we know very well. We know their model. So for them, it's a little bit easier to raise. But 4 weeks, you should give yourselves 4 weeks to, yeah.
One of the things that I've found as I've started to work with more and more institutional and sophisticated investment groups is you feel like I should send them my 100-page deck and super buttoned up, and that thing took me 4 weeks to put together and all of this stuff. and then they'll come back with like really quick questions, or like you said, Garrett, a thumbs up emoji. And I've kind of realized it's probably more important to just put the deal in front of them than it is to actually put together an entire package, because it might be a quick no, it might be a quick yes. And I always say, like, the best thing is a quick yes. The second best thing is a slow yes. The third best thing is a quick no. Because if you can tell me no right away, then I can move on and start making some contingent plans. Is that kind of how you guys have found it?
I think it's more true today because volume is down. If, in 21, when people were if they were just sending us stuff that was half-baked, that probably wouldn't work. But today, I mean, I'll spec some time because their transaction volume is down 70% from the peak, so I've got more time.
Yeah. Okay, so I shouldn't just send you
Especially
over,
if your name is Garrett.
Random,
if there's other Garretts out there, talk to me after.
If your name is Garrett, send something to Garrett. Deal. If your name's Tyler, send something to Tyler. And Tyler, is that what you're kind of seeing too? Once you have the relationship with those folks, can they send you stuff, or really should they hire a placement agent, be super buttoned up?
I think for us it's slightly different. Like our volume as like a lender is not down. In fact, I'd say we're as busy as we've ever been, especially in our like bridge space where we're trying to reset capital stacks and just solve those issues for sponsors. It's not just, I would say acquisition volume, definitely down, but just trying to solve all these busted capital stacks on these refis.
Doing God's work.
We're doing God's work. So like, look, we might get in 50 to 75 deals a week. If I don't have all the information in front of me to make a quick decision, I'm probably not going to be able to spec the time and get you guys the answers quickly relative to other people that have. I don't need like a full 50, 100-page OM, right? But like, give me some photos, a map, and like the Excel model. Fine.
Right.
Yeah.
What are your guys' thoughts on placement agents, debt and equity brokers? Should I hire someone that can make the introductions to you folks, particularly as I'm getting started out and scaling up? We should just go rapid fire on this one down the line. Bobby.
Yeah, introductions. We because we know that the person doing the introduction has already probably vetted the deal as well, and they've got their reputation behind it. Mm-hmm. So warm introductions are always welcome. But yeah, other than that, you can just reach out to us. We only meet once a week for the presentation. So it's a little bit constrained in that sense, whereas, you can reach out to them on a regular basis. But the presentations, that's a little bit of a blocker, but we eventually will get the frequency up a little bit. But yeah, for now, just once a week.
Right. Tyler, to get into the institutional world?
Yeah, I mean, I'd say probably like 70 to 80% of our deals are brokered. 20% to 30% are direct. But I would encourage you guys to work with a broker because they can help navigate, our hot buttons as lenders, as equity, groups. Like they can help you formulate, your pitch, key in on certain things. So like, unless it's like a layup, I would encourage you guys to work with a broker.
Mm-hmm. I agree almost entirely with that. Yeah, sometimes even it's guys and girls but you don't want to say something to them that you think might offend them. Yeah. And so it's nice to have a broker there. He's like, hey, it kind of doesn't match with what I'm seeing. And he's like, let me go check on that. Goes, finds it. Oh, it's actually this. And the deal can continue. So sometimes just having that third party can save a transaction.
Yeah. So while it might be good to be best friends with these three guys like I am, I like to say America's coin operated, and a lot of the times it can be pay to play. And who do I need to talk to have represent me, to put me in the room with the person that's going to be the right match for me as a sponsor and for the deal profile that I have out there? Is that kind of like, it's a matchmaking exercise in that way?
Yes, and I'd say it doesn't count against you if you're using a broker instead of going direct. It doesn't offend my sensibilities at all.
Okay, that's a great touch base. If you guys were designing, starting a new shop today, designing the perfect real estate sponsor, what would you do differently than what you've seen kind of in the marketplace? Or if you were starting a new shop, what kind of deals would you folks be chasing?
$55 billion, no, I think it would be. We've reset our parameters to 1980 and newer construction. I think if you have the guts for it, 70s product right now is just such an area of opportunity because the buyer pool has thinned out, the equity pool has thinned out. frankly, 80s too. I kind of like our 80s stuff, what we're doing. So I would be focused on 1980s built because it's getting passed over by more buyers and more equity groups. And I would be probably trying to buy a lot of stuff right now, 100 to 250 units that can have its own management team on site. You can be efficient. I'm looking for cap rates that are no less than 5 3/4 cap probably on the T12 numbers. That way I can be a 6+ when I go in and have positive leverage. I haven't looked at the 5-year treasury today, but I hope it's still positive leverage. And be doing positive leverage deals that you can either hold for 3 to 7 years. Because no one counted on 500 bips of rates coming up. So this seems like a much better time to be buying than in 2021.
Interesting, particularly on the 80s vintage, because I do feel like I hear about that getting passed up a lot.
Yeah.
People are going for the newer and newer stuff. And Bobby, are you seeing that as well? Where what do you think on that play? Should people be skipping the 1980s, or should they go in on it a little?
So it's really interesting. There are some sponsors that are really good at 1970 stuff. They can go in, they have the crew, they know how to completely rehab the property and make it look like a 1990, 2000 property. There's a lot of those people. But if you don't have that construction background, then it's a little bit challenging. As far as your question about what would I do if I was to start a new sponsor, I would look to find the best team members for the asset class that you're really going after. So one of my favorite asset classes right now is office space, for example. Super hated, super distressed. Maybe not so much in Miami or in parts of New York, but in many parts of the country, people have just hated, office space. So there's some niche there. But I would be looking for great team members, and focusing on the assets that you have a lot of expertise in, and then building that up. And but yeah, on the 70s, 80s. Somebody who doesn't have the right experience, that could be dangerous if they don't know what they're getting into, especially with permits and zoning and so on and so forth. The cities can hold you back. Making sure you have done your proper inspections to know what kind of plumbing, what kind of roof, what kind of AC systems, HVAC, foundation issues, making sure you've got all that covered. But yeah, I think like Garrett said, there's some low-hanging fruit if you know what you're doing in the 70s, 80s.
Mm-hmm.
I'll take this from more of like an institutional perspective. We have $40 billion in AUM. A lot of that over the last 5 years has been multi and industrial, and I think those spaces are just very, very competitive. And it's where we're seeing the opportunities in these alternative asset classes, so like self-storage, for example, data centers, life science, those types of asset classes. I think there's a lot of opportunity from a yield and just diversification perspective. There's just not as many people doing those deals. So that's where I would probably focus.
That makes a lot of sense. So variety of perspectives up here and a variety of asset classes to kind of be chased, it sounds like. If I'm looking to explore a new asset class, have some conversations with you guys, what's the best way to kind of put myself in front of groups like yourselves and get in touch with Garrett and Tyler and Bobby?
Have an active deal. That will get my attention.
All right.
I don't even need an active deal. You can just reach out. I'm happy to talk with you guys.
Awesome.
Same. You can reach out to us, attend our webinars on Fridays. But of course, we only focus on live deals that you have an LOI and you're actively raising for. Maybe you've raised, maybe it's a $10 million raise. You've raised 7 of that already, but you just need to fill in the rest of the gap. That's where we come in. We can help you out, make sponsors' life easier. So instead of having 200 coffees or lunches or flying around, you can just come to one place, present to us, and if it all works out, get a $2 to $3 million check. It's a really relatively simple process. So I encourage all the GPs in the room, if you have a live deal, just reach out on connectedcapital.fund. There's a deal submission form, just fill that out. It comes to my partner, Madhvi, and myself, and then we'll connect back right away with you.
So it sounds like even though deals are tough right now and people are saying capital markets are locked up, you guys are still out here. You're raising, you're writing big checks, deploying capital, and you guys are making deals happen every day. Is that a pretty good summation?
Yeah.
Trying.
Awesome. So you just got to find the right people to get in front of, folks. Let's give it up for these guys. Thank you so much for being up here.